My name is Michael Duke, and this is the show where I analyze stocks and other things. And let me tell you, the clown show is in full bloom today. It's been 3 days, and I tell you what, I filmed like 3 videos about this company yesterday and had lots of technical difficulties in recording, editing, and have you not. So here we are again to redo this video for hopefully the last time. I will say I did just record and upload a video a few moments ago about the market, the US market indices in general. And I realized that the whole time I was recording, I had wing sauce on my face. I noticed it was all over my face. Sadly, uh, I did not notice while I was editing the video. So maybe you will not notice as well if you were to watch my most recent upload prior to this one. But I digress. Today, I'm going to be talking about VICI Properties Inc., ticker VICI. This is a real estate investment trust that is very well known among dividend investors, we'll call them, and also universally well liked. You see here, of the last 10 articles written on Seeking Alpha about this stock, every single one has a buy. A couple of them have a strong buy. Furthermore, the Seeking Alpha quant grade is a strong buy as well. And it's got green all across the board. But do I agree with this assessment? I'm going to be exploring that today. I'm going to be giving an overview of the company, taking a look at their numbers, giving my opinion on it. So, as usual, this is not financial advice. However, it is a deep dive into a very interesting real estate investment trust. So, let's go ahead and get started. So, what is VICI? What is VICI Properties? Well, the name comes from the phrase Veni Vidi Vici, a Latin phrase used to refer to a swift, conclusive victory. A conclusive victory over what? I'm not so sure. However, commonly attributed to Julius Caesar, Vici means I conquered. And of course, why are we referencing Caesar? Well, the company was formed in 2017 as part of the Chapter 11 bankruptcy restructuring of Caesars Entertainment Operating Company. So the Caesars Casino Company owned a bunch of their real estate. They were bankrupt. They spun it out to get the maximum value out of it. So the spinoff was completed October 6, 2017. And initially, the company started with a portfolio of 19 casinos and racetracks, all leased to Caesars at a total initial annual rent of $630 million and 4 golf courses. Wouldn't you like to have $630 million? Because I sure would. Veni Vidi Vici. Shortly thereafter, MGM Growth Properties, which kind of the same idea, but under MGM, not Caesars. They submitted a bid to acquire the company for $5.9 billion. They rejected the offer, deciding instead to IPO the REIT. So it was a REIT, but they wanted to IPO it on the New York Stock Exchange, which they did. Interestingly, MGM Growth Properties was acquired by VICI in April 2022 for $17.2 billion. So VICI today is mostly the real estate of Caesars and MGM. Okay, that is what it is. This is their most recent investor presentation here, dated February 25th. Everything in blue that you see is VICI. And then they also have some. I got to be honest with you, folks. I'm a little confused by this graphic because they show these other assets here. Okay. And I don't know if they're just highlighting that because I don't know why they're highlighting that. It's unclear, but we do have like somewhere along here they say that they own the land under the sphere, or that they have an outstanding $350 million mezzanine in the Fontainebleau here, which is one of the gold highlighted areas. But either way, kind of disregarding the what I believe is a confusion in the graphic for a moment. VICI has, as the largest owner of hotel room real estate in America by key, they have 60,300 hotel rooms. Okay. Of which 41,000 are on the Vegas Strip. So that gives you an idea of the geographical concentration of the portfolio. I don't have this data in front of me. I do have it in the 10K here, which we can look at, but a significant amount of the cash flow is being generated within this photograph. So that's what you own. That's what you own when you make an investment in this company, is an equity position in the leaseholds, or in the properties. Here's why this company is interesting. Again, as reported earlier, we have Caesars and MGM across 31 of the 93. That's exactly 1/3. 31 of the 93 properties between these two tenants. That represents 74% of the rent roll. Significant tenant concentration. However, the weighted average lease term is 30 years for Caesars and 50 years for MGM. Now, it says here that that's inclusive of tenant renewal options. So that's not firm term. However, pretty darn good. I challenge my viewership to find another real estate investment trust that has a weighted average lease term of 41 years. Somewhere along here, they make a comparison to select triple net lease REITs, which means ADC, BNL, EPRT, triple net, Realty Income, and WP Carey. I don't know what these symbols are, but I do know these symbols. Okay. So we see here 8 to 14 years is the WALT of that peer group. And what's interesting about VICI is 42% as of this year, 42% CPI-linked rent escalation over that egregiously long weighted average lease term. So that's pretty good. We got contractual cash flows for several decades into the future. Okay. That's pretty interesting, right? You can see why this might be appealing to a specific type of investor. However, the question is it attractively valued? Now, this is anomalous in REIT world, as we've discussed. This is also anomalous in REIT world. To have 3/4 of your rent come from two tenants, that's seems a little risky, doesn't it? Well, to that end, this is the 10K here, the most recent 10K. Let me find what I was reading earlier in the risk factors section right here. Our properties on the Las Vegas Strip generated approximately 48% of our total revenues for the year ending 2024. Okay. So obviously, what does that tell us? That those tenants have rent elsewhere. Okay, fine. But 48%, half of our rent, again, is coming. Half of our rent is coming from here, right? So that's what you own, folks. I mean, among other things, but you have significant concentration in Las Vegas real estate, and not like a rental house, like the trophy assets of the Las Vegas Strip. So that's actually pretty interesting, right? It's very specialized, very niche, and really, in a lot of ways, very mody real estate. You can't just go create another uh, MGM Grand or another Caesar's Palace or another Luxor or Excalibur, right? Mandalay Bay, you name it. You don't, those aren't commoditized pieces of real estate. And that's really the location and the specialized nature of the real estate is the double-edged sword of real estate. If these tenants were to ever leave, if Caesars were to, again, they already went bankrupt, right? If Caesars were to fold and that building were to, there'd be no money to pay that rent, there would have to be another very large, well capitalized casino operator setting up shop within that building. The specialized nature of that building is what makes it special and valuable and worth so much in rent on an annualized basis, but it's also what makes it risky. Okay. We see here average rent per asset 33.5 million. So average rent per asset, even at a 10 cap, that's a $330 million building. And it's probably worth more than that. So some of these buildings are worth $500 million easily, if that's the kind of rent that we got. So incredibly, incredibly valuable real estate. I mean, you even see here October 24th, $435 million renovation. And that's just in New Orleans. That gives you an idea of $100 million in Mandalay Bay. Gives you an idea of how big and valuable these assets are. And just to further illustrate the point, this here, their portfolio, you can get here by going to their website and navigating to the portfolio tab. So obviously, Caesar's Palace, very, very iconic. The Venetian, the Mirage, Mandalay Bay, MGM Grand, the Luxor, the MGM there, and then we've got a golf course. Okay, so here, MGM National Harbor in Maryland, the Beau Rivage in Biloxi, Mississippi, Horseshoe Bossier City in Bossier City, Louisiana, the Borgata or Borgata, I'm not sure what that is, how to pronounce it, because I'm not from Jersey, Atlantic City. And then we've got the Harrah's at Lake Tahoe. So obviously, each of those markets, and then Vegas, of course, is a gambling oriented destination. And this REIT just so happens to have a trophy asset there, right? I mean, this is the iconic Atlantic City building, right? Here's where we get more into the experiential side, the Chelsea Piers, right? Pretty cool. Super valuable. I mean, just look at where that's located. That's like Midtown Manhattan, right? And then these are some of the hotel assets. You get the idea. So very niche REIT. You see over time, they've had pretty phenomenal growth. These numbers here represent adjusted EBITDA. We've gone from 690 million to 3.1 billion. I want to take a look at their financials. And before I go to Seeking Alpha, there's just a nuance that is worth understanding if you're going to look at the Seeking Alpha numbers. You see here, this is their balance sheet. They have their assets recorded basically like the receivables, like the present value of all the cash flows is kind of how they It might be simpler or more complicated than that, but that's the way I'm perceiving that. Is they're saying that they have leases, that's what they own, and then they have some debt investments too. So you see that borne out when you look at these financials here on an annualized basis. Remember, 2018 is kind of the first real year that we get to look at this. You notice there's some information missing, and that's just because of the way that their numbers actually look in the source documents. But we're going from 900 million of revenue to 3.8 billion. 4 times 900 would be 3.6. So a little bit more than 4 times. You see here how little depreciation they have. Again, that is due to the nature of what they own. They're saying, hey, we own leases, not buildings, really, is kind of my interpretation there. A little bizarre, but we see operating income 770 million to 3.5, which is about 4.5 times as well. Earnings from continued operations 532 to 2.7, very strong growth. Again, remember, from this year to this year is when we purchased MGM, the MGM REIT. Okay, so we more than doubled our net income from doing that. And something to consider is, as with any REIT, the rate of actual cash flow growth versus shares outstanding. You would expect and hope that our growth in our financial growth outpaces our growth in shares. And we see from 367 million to 1 billion shares, that's all, it's about 3x. So yes, given the rate of change of all these numbers, yes, we have seen very accretive growth. To that end, I want to look at the balance sheet. Again, balance sheet looks weird because of this. Understand that. Like you see here, we have 275 million of real estate. This is like a $30 billion market cap company. See how we're recording our buildings as receivables on the balance sheet. Kind of bizarre, but that's what you need to understand if you're looking at the Seeking Alpha. So if, again, it's not quite that simple looking at these numbers, but we're going from 9 billion to 43 billion. That's almost a 5x. That's pretty freaking good. Now here, debt, we go from 4 billion to 15.4 billion. So a shade under 4 times. So we did finance our acquisitions partially through debt and partially through equity, because again, our shares went from it was like 300 something to, these numbers are slightly different than what we saw in the income statement, but more or less the same. This is 2.5 times. So look, financials look great. The REIT has grown very, very strongly over time. And that's resulted in a 7% compound annual growth rate in the dividend. Very, very strong for a REIT, especially considering that the yield, the dividend yield has been above 5% for pretty much that entire time. So that's good, solid double-digit chowder number. Dividend plus growth, very strong. So yeah, again, if you would have bought at the IPO, interestingly, it says October 16, 2017 here. If you would have bought at IPO, you'd be close to a double-digit yield on cost. And furthermore, our 5-year compound annual growth rate of adjusted funds from operation, almost 9%. Very strong growth. EBITDA has grown very quickly over the last several years. Funds from operation, again, grown very, very strongly. However, what's the problem here? What's the problem? Well, the problem is that the operating environment for real estate companies is very poor compared to what it was even just a few years ago. Very poor right now. The reason for that is higher for longer interest rates, meaning higher cost of capital. The prices on a lot of assets, commercial real estate, not as much, but the prices on a lot of real estate are, at all-time highs. And the cost of capital has really increased substantially from what it was in, 2021, 2022. So, as such, real estate investment trusts, public real estate has been in a bear market for several years. I covered this in my video about Prologis. Okay. But one thing that we have to take into account is this company has basically been growing at, 7 to 9% over the last 5 years. And since inception has been growing quicker than that even. Okay. So we've seen very strong growth. Now, all of that growth has come from acquisition, or the majority of that growth has come from acquisitions, as it usually does with real estate. However, the problem here is that there probably will not be that level of growth in the near term. So we see here, again, this is February 20th, so about a month ago. Year over year numbers. Revenue is increasing 4.7% year over year. Net income decreased due to the impact of the change in the CECL allowance. What we care about is funds from operation. Funds from operation, adjusted funds from operation, increased 5.4% year over year on a per share basis. So right off the bat, we're seeing that growth is slowing, right? Growth is slowing. And this is on a quarterly basis, the prior year's quarter. Weighted average shares increased 1.7%. Subsequent to quarter end, they got a $2.5 billion multi-currency unsecured revolving credit facility, announced the establishment of a strategic relationship with a $300 million investment into a mezzanine loan. So then for the full year, revenues increased 6.6%. Net income increased 3.3% on a per share basis. AFFO 8.4%, 5.1% on a per share basis. So here's the kicker right here. Announced approximately 1.1 billion in capital commitments. In other words, this was the money they put to work at a weighted average initial yield of 8.1% in deployed capital in every month. So they're outlaying money at 8%, but their cost of capital is, your dividend is 5.5%, and your debt financing is about the same yield. So here's the problem. You're outlaying $1.1 billion. Your cost of capital, let's just call it 5%. So you're getting a 3-point spread on that. Well, 3% of 1 billion is what, 30 million? Okay. Of accreted cash flow to the entity. That's like a 1% increase, right? So 1.1 billion being put to work is a small amount. And then we also, they increased the dividend by 4.2%, which is pretty good when your shares are yielding 5.5%. I mean, that's like a solid 10%, close to 10% chowder score. You just have to think about what we're seeing here. For whatever reason, what we're seeing, here's their debt financing. So that gives you an idea of their debt costs between, 3.75% and this, and then plus whatever our revolver is, which is probably higher, 7-8%. I don't know. Just shooting in the dark. What was I saying? I was talking about how it, as is common that we've seen in the real estate world, real estate companies are deploying less capital right now because capital is expensive compared to what it was in the prior few years. Just something to keep in mind. I think if you're looking at this REIT and you're thinking of deploying capital into it, I think you have to expect a lower level of growth than what we've seen over the last few years. And as I'll explain here in a moment, I don't believe that that is a deal killer here for the stock. So let's talk about that now. Let's talk about why this might, despite slowing levels of growth, why this still, to me, in my opinion, does look like an appealing investment for the current market environment. As I covered in my video that I released earlier today, I took a look at the all three major U.S. indices, the NASDAQ, the S&P 500, and the Dow Jones Industrial. And all three are showing early confirmation of a downtrend that is steeper of a downtrend than what happened in 2022 when markets sold off like 20%. Okay. So further downside is ahead potentially, and we are in a bearish market for most US equities. Here was the last bear market that we saw here in the S&P. Okay. What do you notice about VICI? What do you notice? Well, it was correlated. You see how they went up and down kind of in lockstep. However, overall, VICI performed exceptionally well. This is total return, so dividends included and reinvested. VICI outperformed the market. In fact, when the S&P was bottoming, down 20%, VICI was still up 9% over the onset of this time frame. And notably, over 3 years, we've still outperformed the market. Okay. So investors flocked into this investment because of the relative stability of the cash flows. If we extend that out to 5 years, the outperformance still holds. If we extend it out to 1 year, the outperformance still holds. If we go year to date, which year to date, it's been a tumultuous year in the indices. Again, the S&P is down 3.2% as of yesterday. It's even worse today. It's down 2 points today so far. Okay. VICI, on the other hand, is outperforming the S&P by 15 points. And this was the day of their earnings. So it popped on earnings. Meanwhile, February 19th was the day that the current downtrend started. So there's a lot to like about the way that the market perceives the stock. This position is trading as a relative safe haven. The reason for that is what we've covered before, is the fact that you have highly visible contractual cash flows far out into the future. However, your tenant concentration is going to create risk. So I really like how the stock is. Casinos should not be defensive, and casinos are not acyclical. Okay, here's the catch-22 with this investment. Casinos are discretionary. They're not necessary businesses. They're not essential businesses. They didn't stay open during COVID. This company, this REIT, collected rent the whole time because those operators were ironclad, right? But so here's the deal. This investment is very safe. I would say that's my assessment of it. It's a very low risk and correspondingly fairly low reward investment. You have a dividend yield that is higher than the 10-year treasury. You should probably expect, I would say, 3 to 4% growth annually over the next few years on that. So 8 to 9% total return potential just in yield. The current valuation of 12 times FFO is pretty good. That's like an 8% earnings yield or FFO yield. Okay. Very strong, very competitive yield compared to the market today. I don't expect this stock to have a lot of price appreciation in the near term because all the capital they've outlaid, they're just collecting. They're probably not going to deploy a lot of capital over the next few years. So if you're investing in this stock, it's because you're an income-oriented investor, which I am. So I like it. Last but not least, let's look at the technical analysis. Before we do that, let's just reiterate the risk factors here. The risk factor is that you have an enormous amount of geography concentration and tenant concentration, which are good and bad things for real estate, depending on who you're dealing with. So this stock, this REIT, as long as that's true, it's, in my opinion, I wouldn't ever see it trading at a 3 or 4% yield. It's not going to appreciate like that. I don't think so. So what are you investing in? You're investing in very stable, steady income that's growing at low single digits, which I think in today's market environment is very attractive, especially when treasuries are in the 4%. Obviously, treasuries aren't increasing. The maturity of these leases is actually longer. The duration of the leases is longer than most bonds, and you are having some modest income growth. So this investment, I do believe, will outperform the market in the near term. Okay. It has outperformed the market in the near term. And I expect that in so much as we continue to see the environment that we're in, this stagnating, uncertain, tariff filled environment, that this company will outperform. Now, of course, the health of the casino operators, the health of Vegas, all of that, very relevant. So for that reason, it will never, in my opinion, appreciate too much. Okay. Taking a look at the chart, it's in this, like, what I would call this wedge pattern here, where it's like lower highs and higher lows. It's descending. I mean, this has been going on since 2021. It's in this kind of this approaching this event horizon. The event horizon price, meanwhile, with my crude chart that I drew, is very close to where the price is now, just a little bit lower. Still like 31.35, it says. So for that reason alone, I don't have heartburn if I'm looking to enter a position into this. I don't really have heartburn over right here. Again, this is not financial advice, of course. But my thought is I don't have heartburn over entering a position here because I somewhat expect the price to, if it's not going to go anywhere, I mean, this is out till 2029. If it's not going to go anywhere for 5 years, you're going to have your mid single digit return in terms of your coupon growing at low single digits. So who was it? JP Morgan or Morgan Stanley said they expect the return of the stock market to be 2 or 3 points over the next 10 years. If you believe that, I think that this ticker here gives you the possibility to outperform that market by 2 times. Okay. Again, we have to be really objective about what could happen, and we have to really temper our expectations. If you buy shares in this, you're not going to double your money in a month. Okay. This isn't, this isn't Palantir. It's not a meme stock. All right. Completely different type of strategy. So I will say I do have a position in this. It represents roughly 4% of my entire portfolio. I am down on my shares because my cost basis, I want to say, is 32 something. Okay. Again, my assessment is really, as long as it continues to bounce within this chart, it's a good deal. Again, I think that on terms of a yield basis, which is how you need to look at this company, in my opinion, is in terms of a yield. You see here the yield is very much average for history. Very, very strong compared to the market. We're far above the risk-free rate and growing modestly with tons of contractual rent out into the future. So I would grade this a buy. I would grade this this is a buy for an income-oriented investor looking for a more defensive position. Now, again, I got into trouble because I had the same type of assessment. Well, I had a similar level of safety assessment on innovative industrial properties, and that stock sold off by 40% after I had gave it a buy recommendation. I had actually sunk over 10% of my portfolio into it prior to that time. My portfolio decreased by over 10% in a month. This was 2 or 3 months ago that this happened. Maybe more. And again, the reason that I'm drawing that parallel is because the real estate operator, IPR, had a relatively safe cash flow position within this more risky, somewhat discretionary industry of cannabis. And anyways, that industry is struggling right now. The major tenant defaulted. That composed 16% of their rent roll. That REIT had a higher tenant concentration than VICI. And it just so happens that the one tenant that should not have defaulted did, and their stock nuked on that. Okay. So we see what happens. This stock, I may be saying that it's defensive and it's a good bet for the environment that we're in now. However, you see what happened during COVID. You remember the Vegas Strip was shut down in COVID, right? I mean, I remember that. The stock went down by like 70% in several weeks. This right here is the 10th of February, the week of the 16th of March. So 5-6 weeks later, it was 70% lower. Think about that. Shortly, I mean, within a year's time, it was back to that price that it was at before. Okay. But don't think that this is just some sure bet here, because again, you've got the tenant concentration. So if you think that it's just going to be some cakewalk by putting a bunch of money into this company, you have to be very comfortable with the concentration risk around these tenants, and you have to be very confident in their ability to operate for the next 30 to 50 years, because that, this number doesn't mean anything without that. Okay. So anyways, that'll conclude the video. I do think that it is an attractive bet at the current price, the current market, the current performance that it's had. All signs point to it being attractive at the current level. Just get comfortable with the risks and never put too much of your portfolio into one investment unless it's the right investment. Caveat there. Anyways, hopefully you've had a good time taking a look at this company. I've certainly had a good time. And let me know how I'm doing. Go ahead and comment below. Do you have anything you want me to take a look at? Let me know that too. I try to do my best to cover everything that gets suggested to me. There have been some things in the past I think I've glossed over, but I try to do my best. So please engage with that and let me know what else I might be able to look at. Yeah, that'll be all for this video. I am going to move on to the next one. But until that time, I will see you next time, and you have a great rest of your day. Thank you for watching.